Welcome to Money Talks. I'm your scribe, Jennifer Powell, and today is Money Monday. And so today we're going to be talking about how to read financial statements. So if you're a beginner investor or you're a business owner, it's very important that you're able to read and understand financial statements. Because from financial statements, you're able to understand a company's business activities as well as judge their financial performance. And so we're going to be talking about the three main financial statements that investors look at and that companies use on a daily basis or frequently, which is the balance sheet, the income statement, or rather the profit and loss statement, and the cash flow statement. So we're going to talk about those three statements in the most general way possible so that you can understand, so you have a general idea for each statement and what you're able to learn from them and how you're able to use them in making investment decisions, or if you're a business owner, how those financial statements can kind of help you make decisions for your business. So let's get into it. The balance sheet. So the balance sheet is one simple equation. Basically, to sum up the balance sheet, you have your assets, and your assets are equal to your liability plus your owner's equity. And we're going to talk about what are assets, what are liabilities, and what are owner's equity. Okay, so we have a simple balance sheet here. We can see at the top are your assets. Then your total assets should equal your liabilities plus your owner's equity. So they're both equal 1,500. It should balance out. It's the balance sheet, of course. And what can we learn from the balance sheet? So of course your assets are anything like cash, anything that you can transform into cash that's beneficial to the company. Your liabilities, of course, is things that are owed from the company, is your debt. So it's a bank loan, it's people that you owe, and then your equity is what the owner will receive once all of liability has been paid for. So what can we learn from the balance sheet? So basically the balance sheet, it gives you an overview of a company's assets, who they owe, and how much they have in owner's equity. And from there, you can see how a company's assets are funded. Do they have more liability or more owner's equity? So they're funded through loans and things that they owe people, or are they funded through investments from their owners or shareholders in certain cases? So here I have an actual balance sheet for you to see from the company of Coca-Cola as of this year, March 2019, the ending of the first quarter. As we can see, their total assets equal their total liabilities and equity. If you are a public company and you sell stock on a public national exchange, then you have to have your financial statements available to the public. So any major public company will have their actual financial statements available to you on their websites and in other sources as well. So the equation for the income statement is you take your income or your sales minus your COGS, which means cost of goods sold, whatever you paid for your product. That equals your gross income. And then you subtract your expenses and you'll get either your net profit or a net loss, depending on if your expenses were more than the income you received, then you get a net loss. If your income was greater than the expenses that you received, there is a net profit. So here's an example of an actual income statement. As you can see, you're taking your revenue minus your cost of goods sold minus your expenses. Some people separate the tax expense and they'll have a total income before taxes, and then they'll subtract the tax expense and they'll give you your net income, either profit or loss. So it all depends on how you want it to look. It can vary from company to company, but the equation is still the same. It's still revenue minus expenses equals your net profit or your net loss. So the income statement is used to record how the company performed, how the activities that the company engaged in during the year. Did it produce a profit or did it produce a loss? And just so you know how an actual income statement may look, here's one for Walmart. Of course, Walmart is huge, so this is like a consolidated statement of income. And as you can see, depending on the company, they have various ways of showing what's income, what's expenses. So there's various ways to display the statements, but the general principle is still the same. Revenue minus expenses is going to equal your profit loss or your net profit. So So from these first two financial statements that we talked about, there are two things that we can determine from these financial statements that investors use quite frequently and also management uses, and one of them is the return on sale. So the return on sale is basically what percentage of the profit is kept for the company. So how much of that profit that we received is actually going to be kept for the company, and we get that by taking the profit, which is our net income, our net loss that we received from our income statement, and we divide that by the sales, the total sales that we also received from our income statement. Another measurement that investors use to determine a company's profit performance is their return on equity, and that's basically your profit divided by your equity. And you get your profit from your income statement, of course, it's at the end of your income statement, or loss, and you get your equity from the balance sheet. And so what this basically determines is how much percentage of that profit will be owner's equity. So how much of that profit that we received this year is going to be given to the owner's equity, or equity shareholders. Last but certainly not least is the cash flow statement. And the cash flow statement is split into three different sections of your operating, your investing, and your financing activities. So the cash flow statement shows you how the company actually used its cash on hand during the year. And so we know that the profit or the revenue of a company does not actually equal its cash, or it cannot actually equal its cash, depends on the type of company. But for most companies, revenue does not equal cash, because inclusive of revenue is also revenue that you earned on credit. So you haven't received actual cash for, but you still recognize the revenue because you earned it, you just haven't received the actual cash for it. And so the cash flow statement shows what you actually did with the actual cash that the company has. And like I said, it's split into three different sections. So the first section of the cash flow statement is basically showing you your profit or your receipts from the customers, and you subtract that from the cash you actually have on hand, the cash that was actually used. And then part two, your investment activity, basically summarizes your long-term investments that you have, the cash that you use from your investments. And then the financing activities finally shows you the money that you borrowed and your sources of capital. So here's an actual cash flow statement from Apple. Of course, Apple is huge, so this is a condensed statement. But as you can see, the principle still remains the same. They have their operating activities, their investing activities, and their financing activities. And so from a cash flow statement, you can see how a company uses its cash, how it allocates its cash, and how it manages its cash. Are they putting more money in their investing activities? Are they putting more money in financing activities? Are they pushing out more money for their operating activities? So it's a great way to determine that. A lot of smaller companies don't use a cash flow statement, but a lot of the bigger companies do. So the cash flow statement is one of those statements that may or may not be inclusive of a company's financials. So in summary, the balance sheet gives us the company's financial condition. The income statement shows us the company's profitability and their profit performance. And finally, the cash flow statement summarizes the business's source and use of cash during the year. So I hope you were able to follow along pretty easily about what those financial statements convey to you and how helpful they could be for you as a beginner investor or investor period, and how they can be helpful for you as a business owner. So if you want to do a more detailed video on financial statements to get more in depth about each financial statement, or one in particular that you're worried about, then just comment below. Remember to like and subscribe. If you like this channel, if you like the information that you're getting from this channel, I hope that it's very useful for you, and I hope you're able to use it, because money does talk. You just have to learn the language. Thank you for watching. Once again, I'm your scribe, Jennifer Powell.